Hello, everyone. This is Jeff Foley with Paladin Financial. Thank you for tuning in. We'll get started here in another moment. We still have people logging in, and we're excited to have you. Thank you, folks, for joining. We'll get started in another moment. Still see people joining. All right, we'll go ahead and get started. Again, thank you for joining us here today. I'm Jeff Foley with Paladin Financial, and today in our educational webinar, we're going to talk about getting a head start on tax season. It's coming up here before we know it. So some practical steps that you can take before year end, and we also have a special announcement we're going to talk about here in a moment as well. Before we get into our content today, I wanted to talk a little bit and first thank everyone that's on here. We don't know who helped contribute towards this, but we were voted #1 by White Bear Lake magazine as the best financial services firm in the area. So thank you very much for helping us to get there. We really appreciate the partnership and the opportunity to serve all of you in your retirement journey. Today, we're going to talk about taxes, which seems to be a very popular topic. Every time we do a webinar or a live event about taxes, we get a very good attendance to that. Wanted to kind of, before we get into the topic, give some context of how this fits into the overall plan. So what you see on the screen here, every one of you that's a client, which we see a lot of our clients on here today, this is our approach to serving you. And our belief at Paladin Financial is we're not just handling investments. We want to look at the broader picture and address all of the things that you see on the screen here. And one of the key ones with that is tax planning. So we're going to talk today about tax planning and also tax preparation. If we were to simplify things, we talk about the 4 pillars. If you take all the moving parts that you have to deal with in navigating retirement, you have your health plan, your tax plan, your financial plan, and your estate plan. So today we're going to hone in on that piece, the tax plan. As it relates to taxes, there's a lot that we can nerd out with, and we'll do some of that here today. But we want to be proactive with your tax plan, not reactive. One of my favorite phrases is a low tax year is a terrible thing to waste. So if you're of the belief that taxes are going to go up over time and you couple that with your personal situation, if your income is increasing, it might make sense to take advantage of some of the tax laws that we have in place today. And third, we want to make sure that your tax plan is coordinated and integrated with those other 3 pillars that you see on the screen. And that's what we're about and how we add value to our clients. As we look at the tax landscape, this is one of the most common things we hear from people is they're not happy with whoever does their taxes, and they've had bad experiences along the way. So in listening to you over the last several years, what we've heard is the tax preparation industry generally has a very reactive approach. It's not proactive. It's hard to get calls back, responses to emails. You have to follow up multiple times, which is not ideal. And a lot of times, again, being reactive, there isn't proactive tax planning with that, and your tax and financial plan oftentimes are not coordinated. Your tax person is not talking to your financial advisor a lot of times. So this can create some missed opportunities, and our belief is this is only going to get worse. If you look at the tax preparation industry, there are a lot fewer people coming into the industry than are joining it. And we've seen a number of firms, and our guest will talk about this here in a little bit, has probably seen this in his neighborhood as well. But a lot of firms are increasing their cost to the client because they only have so many hours in the day and they can do that. So you're seeing costs increase in a lot of situations. So with that as a backdrop, very excited to announce this as something for those of you that have been with us for some time. We've talked about this. We want to do this. We want to do this. We are now launching Paladin Tax Services. So we're very excited about this to offer you a solution for not only tax preparation, but planning as well. And our belief is this is going to have a better outcome for you from a tax planning perspective, save you time, reduce stress, have that better communication, and it's backed by the same people here at Paladin Financial, the values that hopefully you're all enjoying and what we believe and how we serve each of you. And the goal of this is to integrate your tax plan and your financial plan through this. So we are launching Paladin Tax Services, and in conjunction with that, we have a partnership we'll talk about. I'll introduce William here in a moment, but some of the services that we're going to offer, again, that coordination, tax preparation and filing, obviously, tax projections and planning, streamline the communication between tax and financial, and whether you're an individual, family, small business owner, these are all things that you can take advantage of. The strategic partnership we're excited to announce with this is we have William Nusser from Simmons Simmons on with us. And William comes to us, and his firm comes to us, a referral from a lifelong friend Nikki and I have. We're from Kansas, as many of you know. William and his firm are based out of Kansas, so there's a long connection there and backdrop, but very excited. He has worked with a number of clients over the past year, and we're launching this partnership in order to provide you with tax preparation services and planning and so forth. So William, if you don't mind, again, welcome and thank you for joining us here today. If you don't mind, tell us a little bit about your firm and what you guys are about and where you're at.
Yeah, so our firm is Simmons Simmons Public Accounting here in Kansas, and we've actually been servicing our community in the area and really the country since the early 1930s. We are the current operators today, my wife and I, Caitlin, but really the firm itself originated in 1932 with Bill and Everett Avery, went through a transition where Bob Pavanka had purchased, and then Kevin and Joe Simmons had purchased from them in 1988. We actually acquired the firm from Kevin and Joe in 2017, and we have owned and operated since then, and been happy with the growth and connections and the client services we've been able to provide. But something we're really proud about in firm tradition and what we go through at Simmons Simmons is the client and accountant interaction is critical to all services that we provide here. So that's something that we look as preparers, and it's kind of interesting. We'll get a new client. They say, when I call, who do I ask for? We're like, well, you'd ask for your accountant. They're like, well, the place I was before, I couldn't get a hold. I didn't know who did my return, and that's something for us that we want to be very forward-facing and accessible to our clients. We really believe that is what differentiates our firm versus others, is that when you call into the office or send an email, you're going to send and talk directly to your accountant. You're not going to go through an intermediary or a side there. That if you want to get a hold of us, that's the key, and that you want to be there because it's about that communication. You're building a history. Every client has different goals, and our goals are to get you where you want to be. So that's what's important for us is client communication, the planning, and that. We'll kind of go through some options that we have for this year, but really that's what it's about in the firm background. We're really happy that we're approaching 100 years in operation, and we continue to hopefully provide that stellar service, but we want to be different, and that's what it's about, is access and availability to have your accountant. So if something comes up during the year at any time, not just during tax season, that we're available for you.
Yeah, good. And we've had a great experience with you and your team, and have really enjoyed the relationship, and excited about things to come. So one of the things people might notice behind your name, you see the term enrolled agent. Would you mind explaining a little bit the difference between an enrolled agent and a CPA?
Yeah, even when I went to college at Washburn, that was the whole path for me, was becoming a CPA, and stayed there the additional 5 years, got my 150 hours, so you could sit for the exam. But when I was hired on with Kevin and Joe, you had to have a peer review side, so I learned about the enrolled agent path. The primary difference is our licensing is administered by the IRS and the federal government instead of the local state agencies. So our CP requirements, our ethics, our Circuit 230, that's all regulated by the federal government. The nice part about that is because we are licensed via the IRS, that gives us also 50 state capabilities. So really today we're servicing about 33 states, and we're proud of that, and the work that we've been able to develop a system to be able to work with people that are remote and from other areas and still be able to provide that high quality service. But that's predominantly the thing. But I think another piece is that we are tax focused. That's entirely what our firm is built around, from the accounting, bookkeeping services. It's all coming back to that tax return and just making sure we're communicating on that side. There's not going to be any times we're going to be distracted away from that. All of that is kind of circling back to that tax return preparation, making sure that we're putting you in the best position.
Good. And CPA is kind of a broader designation, if you will, whereas enrolled agents are focused primarily on the tax.
Yeah, we consider it a tax specialist, and that's really what the firm, when you look at a public accounting firm, and we do a lot of work for government municipalities, but really it's about tax, from sales tax, income tax, estate tax, and that's really where we're focusing. In all of our CP and educational requirements are all focused on tax updates. We're required with our enrolled agent designations to at least have 25 hours of continuing education that is just federal tax focus, and that's what I think is really good. This is November traditionally is our tax kind of education time because the new laws hopefully are implemented and in place by then. So, we're putting in 30 hours of just training this month, every member of the staff to get it updated on any new changes with tax legislation.
So you have in the tax preparation industry, you have tax preparers, and literally anyone can hang out their shingle and be a tax preparer. I think with H&R Block, it's like a 2-week training course before you can do tax preparation. Enrolled agents and CPAs both can represent clients before the IRS. So if you get audited, something like that happens, that you have the ability as an enrolled agent to stand behind them.
Yeah, correct. Really, with that side with the IRS, we're filling power of attorney forms out. All correspondence come through us. Really, you wouldn't have to discuss or even be forward facing the IRS at all. We kind of be there, the intermediary in the event of the audit. And that's what we've done in the past. Is if that happens, then you get listed there, and any correspondence the IRS sends also has to come to us, and then they can't really kind of speak through without having us present. And that really helps because it helps ease a lot of the stress. An audit's never fun, and our goals and with our system too in back office, we spend a lot of time making sure that we're documented when we prepare returns. When the audit does come, we've got all the information readily available, and usually they're pretty seamless processes.
Good, excellent, thank you. So yes, again, we're very excited about this announcement and partnership, and our approach with this for this first tax season. So this is available for the 2025 tax season. Our phase 1 with this is to focus on providing you with a very good tax preparation solution. We've heard from a lot of our clients, they're not happy with whoever is doing their taxes. We have that solved. Our phase 2, so moving into more of the 2026 tax season, we're going to be adding more and more benefits in terms of that integration between tax and financial planning. So we'll talk more about that over the next year, but we want to get things started with having a tax preparation solution for 2025. With that, I'm going to turn things over to William and talk about some of the topics today as we look at end of year tax planning and some opportunities for you. And I'll try to advance the slides for you as we go along.
Yeah, so some of the goals we want to kind of just go through today is to give a little bit of firm insight of what we're working with our clients regularly when we talk about tax planning year end. There is some provisions that we've seen in the One Big Beautiful Bill Act that's going to create some changes here, some unique planning opportunities in the short term, and then also just making sure people have some updates in the thing of that is not for you to be an expert at what tax legislation is, but to give a little ideas to understand that if you have things that these are of interest to you, we want to be in communication. If you're looking at, we'll go through a couple items that if you're saying, hey, I think I may be interested in that path, well, there's some areas that you have to go through in layers to make sure that we're being eligible. And we like to tax plan. What we mean by that is that it's way better to execute before 1231 hits, because really once that time comes, there's a little bit of retirement contributions and stuff you can do after year end, but really it's a lot better to do those before year end. You have a lot more planning points and availability to make some direction. So we'll kind of go through theirs and just talk about some opportunities with smarter tax planning. One of the things that are interesting pieces with the Big Beautiful Bill piece is that they did put some temporary tax breaks in through to 2025 first year and then through 2028. And our goal is to kind of focus on the better we can make your taxes more efficient, the better wealth you can generate. Now, with that also doesn't mean that we always want to have the lowest taxes ever. For example, if we inherited an IRA that has a 10-year withdrawal limit, yeah, for the first 9 years, I could do great for you in your taxes and not have any withdrawals. But in year 10, when you have the entirety sum of the withdrawal, you would probably pay more taxes over the span of the 10 years and spreading that out. So that's a lot of the discussions when we talk about tax planning. Yes, 2025 is a critical year and the most we're focused on right now, but we don't want to make a decision in 2025 that's going to hinder 26, 27, and 28, and then ultimately it was a poor financial decision when we balance those pieces across. When we build into Social Security retirements and a lot of deals there's a lot of things that can be moving, so we want to make sure we're communicating that your overall tax plan, not just 2025, but over a 5 to 10 year window, is in your best interest. So when we talk about tax planning, it's empowering, understanding what the rules and regulations are, but as a firm, it's not finding loopholes or doing things that's unethical. In our practice, it's important that ethics are very high end for our firm and our clients and our preparers. So we are going to go by the rules and what that is, and that's our job to guide you what the rules are, but try to use those to the best of your advantage. So don't think on that side that we're going to put you in a position that's going to put you precarious. Really, when it comes to an audit, I don't carry a lot of concern personally, because I know on the front end, you do it right, we're documented, we have supporting documentation, so when that audit comes, we're ready there for you. We really got to go through the IRS paperwork, but really it's a formality. We're not putting you in a position that's going to create any risk.
There's a big difference between tax avoidance and tax evasion. We don't want tax evasion.
Yeah, and that's the thing is in our role we are regulated by the IRS. So when we look at our credentials and our careers, I think that's a good system they have in place, that we're not going to put ourselves at risk and put you at risk in any situation when we prepare a return. Because when we sign that return, it matters to us that we're adhering to the rules. So we look at the big beautiful bill, a couple key provisions, and we saw a lot in the news throughout the last year. And we talk about tips, overtime pay, those are kind of some critical things. So when those are mentioned, during elections, and you get it, and then it gets into a bill, what does that actually mean? So the tips does present a unique opportunity that they're going to allow you to deduct your tip pay. I think that's going to be a little bit simpler to figure because the way the W-2s are created today, I think we're going to be able to get that piece figured out. But an important thing to the tips to note is that they only have approved industries where they believe those are standard industries that would have tips. So for example, in accounting, that's not a traditional thing that we get tips in our firm. So we can't just start saying, okay, I'm paying my staff in tips to create a deduction for them. So they do have a regulation on that side and how that's going to be reported. You are able to deduct up to $25,000. Now there are some AGI phase outs. So you want to make sure you're in communication. The primary thing, if you are in a position or know somebody that does receive tips, making sure that you're executing to the employer when that W-2 comes out after the first year, that the tips are distinguished on that document itself. So that's going to be a big planning point of how that's going to execute and come back through there, but can be substantial that they're going to make the tips tax-free. It's going to be interesting in our world a little bit because a lot of times tips aren't reported on the W-2s if that changes to get a little bit more compliance there or not, but they're only going to allow you to deduct what you've already included on your W-2 income. If you're getting cash tips that aren't included in there, we wouldn't really advise to take an additional deduction for somebody that's not included on the W-2.
So it's possible someone could get their W-2 in January and they have legitimate tip income, but the firm that they work for doesn't have that split out.
Yeah, if you look at a small employer, they're just trying to do the best they can, get W-2s together. So even for our side, a lot of our firm business is we do a lot of payroll and live payrolls after the fact. So we're making sure that we're going to have that documentation ready. So if you do receive tips today, it's not bad to reach out to your employer and say, hey, the deductions out there, are you guys ready? What is that going to look like? And I think what we're kind of advising our clients is to keep a copy of that last pay stub for 2025. And then we're going to reconcile that with the W-2s to make sure that the tips, if there are distinguished on the pay stub, that we're tying those out to the W-2 also. What we've kind of went through the last couple of tax schools is they're saying, first year, not a lot of heads up. Unfortunately, right now, the last 60 days, the IRS hasn't been in office. If nothing changes at this point, they may not be in office again until January 1. We don't know. So getting guidance from the IRS on this, we're not expecting. So we're just going to do what we always try to do is the best you can, but we're also going to take a conservative approach to making sure we're not taking anything we shouldn't. So the tip thing's going to be interesting. But yeah, keep that last pay stub. I think that's going to be something that we normally wouldn't do, that I would advise this year to make sure we're tying out. And that's going to go for the tips and the overtime pay. Because it's going to be interesting to see how that goes. So the next step is on the overtime pay. They are going to allow a deduction. If you got overtime pay, the interesting piece about that, the deduction is the additional pay. So let's say you make $10 an hour, your overtime pay is $15, the deduction's the $5, not the $15. So that's going to be an interesting thing, how the employers handle that piece on the W-2. So traditionally, you haven't had to split that piece out, and making sure we get that documentation. So same thing, that pay stub is going to be a critical document that we can scan and have with the return. If we're going to take that deduction, we want to give some verification of why that deduction and how it was figured. But when you're talking about taxable or not, because these are going to be what we call above the line deductions, are going to be there where they're going to not be subject to itemized deduction limitations. It's going to be in addition to the standard deduction. So it's a pretty significant item there that you're going to see. A couple planning points we're looking at, if you have employees that you traditionally have moved to salaried positions because of their management roles and not having to maybe pay the overtime, there's some discussion with that employee potentially. We can adjust how that's being done to provide them a deduction where the income can be tax-free, and potentially to the firm where you could almost pay less in wages because of the tax savings. There can be a balance on both sides. So working with a couple of our employers and clients that seeing, hey, that guy moved to salary, so he's overtime exempt. Maybe it's better off if he's getting overtime now because he's not paying tax on that piece. And we can work it out between the employee and the employer to be better for both sides. Because the difference of taxable or not, you can be a 30% number of how that's going to affect the compensation for the employee. So The next piece is the car loan interest, which is kind of an interesting one. Sometimes in the tax world, we have quirky things that we're interested to watch how it play out. So they're going to allow you to deduct your car loan interest. However, it's on new car purchases. They have to be assembled in the United States. There's a lot of caps and things that go with it. So what we're guiding people on, if you intend to deduct and looking at a new car, and maybe you've already acquired a car, because some of them, it does go retroactive prior to the bill signing. It does have to be on new. There is potential interest deduction. Now, there are a lot of parameters for that. For example, assembled in the United States. They were going through tax school that General Motors makes a Chevy pickup. They make one in Canada, and they make one in somewhere in Kentucky. The Kentucky truck would create deductible loan interest, and Canada would not. So when you are looking at those new vehicles, if you think, hey, this loan interest is the reason why you may pull that trigger, we would advise to reach out, give some discussion where your returns at, to make sure when you're making that decision, you're most informed as possible, because there's going to be a lot of vehicles that are not eligible. So that's something that we got to be make sure that we're cognitive there. You're not going in and saying, hey, I see that new car interest is deductible, you buy it, and you come to get your return prepared, and I got to tell you it's not deductible. So we like to plan and be ahead of any of those decisions in the forefront. It just helps to make sure we have a more successful outcome. The better part that's a little simpler is senior 65 plus are going to have that extra $6,000 standard deduction. And what that means is they're going to take your standard deduction today, they're adding another $6,000 to it. So depending what your tax bracket's at, you can see a 20% savings on that number. So that's a little easier to figure to know on the 65 plus. There are some phase out pieces that can build into there, but that's going to be a nice provision to that bill. So some real benefits, tips we talked about, when you're on a $25,000 deduction, you can see $3,000 to $4,000 cash tax savings. Over time, it can maybe help with a little bit of employee morale if you're an employer, making sure you're distinguishing that, where you can create that a tax-free benefit. We kind of wish that it was going to be the entire of the compensation, but even the difference could go there. But the accounting side of that's going to be interest. So we go through there on retirees, the additional there, and then just looking at stacking benefits of, is there ability to make some contributions, deductions to stay under some of these AGI phase outs and still get the benefits of maybe some retirement contributions in those pieces.
Yeah, it can add up. We just had a review meeting with a client a little bit ago before the presentation. I see they're actually on the webinar today, so they ran home and logged in here. But I think between the enhanced senior deduction and the overtime, there was pretty significant difference in reducing their taxable income for this year. So
I think the key provision about the big beautiful bill that came through is not, there are some of these little differences that have added, but they did maintain the current tax rates. If we wouldn't have saw that, you would have saw probably a 70 to 80% of the taxpayers would have saw an increase. So really maintaining the tax rates is probably the greatest piece of the bill. These other ones just create nuances of what's different, but what would have really been different if you wouldn't have extended the bill that was passed in 2017 is you would have went back to reverted to the old rates, which would have been greater. So that's probably the biggest part of the bill that people won't necessarily see or feel, because it's the same as what it was last year. But if we wouldn't have had that change, we would have seen a tax increase for most.
Good.
So a couple of the strategies, like we said, tracking key, the loan docs, the tips, the overtime, those last pay stubs are some things we normally wouldn't have. Like you buy a personal car, you don't care to bring that to your tax appointment at all. So if you did buy some new vehicles and you don't know eligibility, you've already done it, just have that stuff ready, which we normally wouldn't do. You'd want to have purchase contract, your loan docs that you originated from there to make sure it's not going to be on a refinance of the vehicle or anything there, or on a used vehicle. So it's going to be interesting to see how that kind of works out. We talk about bunching of deductions. I think when we look at year-end planning, and even the long term as we build client relationships, we've seen the QCDs, what we call the qualified charitable distributions, out of the, when you have that RMD requirement out of your retirement account's been pretty strong to basically add to your standard deduction instead of itemizing and hoping you can itemize with that charitable deductions. If you use a QCD, you get an immediate deduction and your standard. So we've seen a lot of tax savings using that.
You mentioned the term quirks earlier. That's a unique thing with QCDs, is you can start taking those at age 70 and a half, whereas your required minimum distributions might not kick in until 73 or 75. So if you are giving to charities, the QCD might be a good move for you if you're at 70 and a half.
Yeah. And what we saw is that when they raised the standard deduction so high, that people that were giving the charities maybe weren't seeing that charitable donation anymore benefit their taxes. So they added that QCD to kind of help offset, because I think they were getting some complaints about, hey, we're not seeing that tax benefit from my charitable giving, and this does now. But the key is, as you know, the execution and communication with your financial advisor is very critical on that. It has to go directly to the charitable organization, and then some agencies and how they report that from the 1099 is critical of how that gets reported too. So we're big on that in the QCDs. If somebody's going to have that annual giving and you're having that RMD, or you're going to have any retirement withdrawal, it makes a lot more sense to get the deduction guaranteed than trying to hope you're going to itemize with as high as the itemized deductions have gotten. So when we talk about the audit proof pieces and the expert guidance is being documented. We're really big on that. Our system with our electronic file cabinet, scanning in, having the client portal, making sure that we're ready in the event of an audit. So when we sign that return, it's submitted. We've got all the supporting documentations for many numbers that have been documented on there. And we do give you back all originals in there, but we also retain a copy for ourselves. So you don't have to carry that stress of if there's a fire, a flood, or any loss of information. We're always going to have what we supported and did on the return with it. So that really helps on that side. When we look at, I think, the acceleration of income and expenses, Roth conversions, I think Jeff's right. We are at some low income tax brackets now. If there's an ability to do a Roth conversion and you have maybe, let's say, a little bit of the 12% or even the 22% bracket available, why don't we take that and fill the rest of that bracket here? Because you're probably not going to get a lower bracket than 12 or definitely 10 at any point into the future. So if you have some options there to do that, I actually have a guy that out of Texas that I work with, and it's fun because he's kind of happy with where he is in retirement, isn't eating a lot of his retirement withdrawals, and doesn't have much taxable income. And I told him, like, we ought to be taking so much of this and you still would have zero tax. And it was kind of fun. He didn't believe me the first year and we did the return. I'm like, you don't owe anything. He's like, you were right. And so we've been actually able to take not large sums because of staying at 0%, but we've been able to take money annually out of his pre-tax qualified monies and put him into still staying invested, but putting it into a different account, tax-free. He's pre-Social Security still. He kind of had money saved, so he hasn't been having to withdraw yet on those, but we're taking those distributions because he doesn't have much taxable income, or if any, to stay at zero tax. He's in Texas, so zero state tax, and been able to take those money out of what we call deferred tax accounts and basically being tax-free to him. Now he's just paying as he goes. And so that's been a really fun kind of prideful moment in our firm that we can help guide you that is way more the outside of the tax preparation.
Yeah, good.
Yeah, so one of the things we like to see when we look at kind of some strategies, if people want to kind of get their stuff looked at or starting to build that relationship, we really want to start looking at this 2024 return, seeing where you're at, gives you an idea of AGI and some phase outs into having those discussions. And we also want to meet our clients. One of the things that makes tax season worthwhile for us as a firm, even though we put in the time and the hours, is I enjoy my clients. Our staff enjoys our clients. We work with the best people, I think, in the country. And I'm looking forward to seeing your appointment every day. When I get ready for the day and I see my appointments through the day, I'm excited to see about how your grandkids are doing or how your kids are doing or how's your business going. And your goals and aspirations matter to us. And that's what we enjoy about tax season, is those either calls via Zoom or in person or however it needs to be, but communicating with the client is what really we try to differentiate, and having those conversations, because you can get so much more accomplished in that conversation than you can corresponding via even email or over dropping stuff off. So it's nice to have those appointments. Now, if you don't feel you need that appointment, that's okay too. We will work with that, but we always want to make sure that's available for you, and that's not an additional charge. If you have an appointment or not, your fee's probably going to end up being the same. So just making sure that's available for the client if they want it.
Go.
Okay. Yeah, so work on the plan there and then figuring out the tax process for us. If you are interested, and Jeff will kind of go through those pieces later, we do send out client kind of engagements here at the back end of the year, kind of giving a little bit of updates and what information to provide. Jeff will go through kind of on Tax Organizer what that looks like, but we're very scheduled on, this is the scheduling time of the year. Our calendars do start to get fuller, so then when we get to tax season, so we want to get you penciled in and scheduled, the sooner the better, so we're ready for that. We will definitely try to onboard the best we can during tax season, but really once that starts and that schedule's rolling, the resources and time can get allocated. So if you are interested, it's definitely reach out to Paladin, they'll get us connected, and then we'll have our staff get connected with you and get that base information, get the prior year return set up, and a lot of that back end work where we're not as time crunched after the first of the year.
Right. Yeah, a few things there. One of the things we try to help our clients with is reducing, if possible, the number of accounts that you have, so that it makes it easier, less stressful for you in getting ready for tax season. And as William mentioned, figuring out your tax process, what works for you to make each year a little bit easier on what do I need to gather, where are things stored, the communication piece of it. So again, our goal is to help make that process go even smoother for you. And then the Social Security statement, if you are still employed, one of the suggestions we would have would be print off your recent Social Security statement, put that in your tax folder for the current tax year, and that would be a reminder for you when you get to next January and you pull an updated Social Security statement, make sure that your employer reported your earnings correctly for 2025, because a lot of times people don't pay attention to their earnings history as that builds up over the years. And if you're 50 years old now and you're not filing for Social Security until you're 65, you don't know what you made back in 2025. So chip away at that each year as you go along.
Yeah, on our side here, we obviously, as a tax firm, we believe in what the profession is and provide. A lot of key pieces that you have that resource and access. So look at your fee when we do that return preparation, that's your retainer. If you got a question in midsummer, something's going on, call, email in, we're going to respond to that. We're not a firm, and it's my belief that we don't really bill for those individual times. We're not going to be like that law firm when you have a 7-minute phone conversation, you get a $150 bill. That's not what we're going to do. We want to help you and be in access. The worst thing that could happen for me is if a client said, well, I was going to call, but I didn't because I was worried I was going to get a bill. That's not what we want. We want to make sure that you feel comfortable in that access to information. And if you have simple questions, we're not going to invoice for that, because we want to make sure that we're a partner to you and supportive of the firm, that we're supportive to you and your goals and your outcomes. One of the pieces that we've seen a lot more interest in probably since 2020 is that W-4. I don't know if anybody's changed employers or changed jobs and since then, but that W-4 has been drastically changed as a document. We used to have that single claim year exemptions, and you kind of knew that if I was single 3, I probably was going to owe, single 2 is getting kind of close, single 1's a refund, single 0, I was getting a refund and a bigger refund. Well, now those documents, people are basically just signing the bottom, not really understanding how that's figuring. And so what we've gotten to a lot more is giving reviews of those W-2s and take-homes pay, because everyone's position on what they want their tax return is different. I have some that like to use it as a cumulative savings to pay the second half of their property tax or save up for a larger expense, or I have families that say, hey, we need the money month to month. And my refunds have gotten I have a lot of discussions annually. If that refund gets too big and you're accumulating debt or cash flow during the year feels a little bit tighter with the way groceries and everything have gotten, well, why don't we adjust that W-4, give you a little bit more take-home pay. Now, the tax rate's not going to be both sides. We can't get more take-home pay and a bigger refund, but we can make that adjustment based on how you want for yours, instead of just, well, I just filled it out, it is what it is, we'll deal with it. We can have those discussions of where you want it to be and get it as exact to the dollar. If you, hey, I'd like to add $50 more to my withholding, or I want $50 more per month, knowing that maybe I'm going to get a little bit less of my refund. But having those discussions and conversations during the appointment is what important is to us when we review and look at that withholding, because everyone's discretion of where it is different. And so that's what's important, to have those communications, instead of just, if everyone just dropped it off and I just blindly prepared returns. Well, your position on how you want your refund to be may be different than someone else's. So making sure we're executing and communicating that with our clients. And those W-4s have just gotten tricky, especially if you've got different part-time jobs and different withholdings, or you pick up a part-time job in addition to your full-time job. It's hard to get enough withholding, so we got to offset the withholding at your primary job. So having those discussions and looking at what your tax bracket and information is. So we talk about phase outs. It's very important that even if a deduction is listed, to be in communication about, hey, am I eligible for that? Because you may see an education credit, oh, my kid's going to college. Well, if your AGI is too high, you're not going to be eligible. So making sure that we're talking about what those phase outs are, Roth contributions, HSAs, charitable strategies. There's a lot of things that build into that. I don't expect our clients to be experts on that, but we just want to be there and be communicated for you. So it's important that you have those prior year information, looking at where we project in the conversation I just had this week. Hey, how's income looking at compared to where we were last year, and different things that are affect, and allows us to kind of strategize here before year end. And then we integrate that when you get to your year end planning with looking at, well, like we said, Roth conversions, contributions, IRA contributions, and looking at what you are and are not eligible for, and trying to make sure we're putting you in the best path.
Yeah, the personalization you mentioned there is that there's so many moving parts with tax planning that you can, as you mentioned earlier, people can have this dialed in with what their situation is, what they want. And as we're talking about, we have a lot of complexity that comes into things. The bill that passed in July added some complexity, but that also can create some opportunities for people if they're proactive with this and they work with a good tax professional to think through how all of this is going to work. So we see that as a plus with that complexity. We want to make 2025, starting with that year, have this be your most tax efficient year yet. And as William mentioned earlier, that doesn't mean saving the most amount in taxes this year. It might make more sense, as he talked about, pull some income into this year to take advantage of some of these additional deductions and part-time opportunities that we have over the next 4 years. But we want to have a good long-term tax plan. So if you are interested in exploring Paladin Tax Services, our ask would be that if you just send us an email, you see our email address, info@paladinfinancial.com. Put your name in there and say, I'm interested in Paladin Tax Services, and we will follow up with you with next steps here before the end of the year. You can also check out our website under the services, a little small to see here, but if you go under services and then tax services, you'll see a description of what we're providing. There's William and his team's bio and information. You can check that out as well. And one of the things that we are going to provide as part of the output of getting your 2025 tax return put together is we're very big on client education. Example of that being here today, we want to spend time and effort to help you understand your taxes as much as possible, and then that can help you to make some very informed, good decisions for your situation. So we will create for you a tax return summary. So once your 2025 return is done, we can then provide you some details and help educate you about where you landed for the tax year. And then we use that as a launch point for 2026 planning to take advantage of the moving parts that make the most sense for you. So that's a piece of our delivery process here. So again, we will reach out to you at the end of the year if you are interested in Paladin Tax Services, and you will receive as part of that process a tax organizer. So you'll identify, here's our personal situation, our moving parts. As I talked about at the beginning of the presentation, our goal, starting with the 2026 season, is to add even more value in that preparation, the preparation for the preparation process, if you will. We also have set up a tax client portal that we'll roll out and talk about that later as well. And so again, next step, send us an email, info@paladinfinancial.com. As we talked about, we spent a lot of time on the One Big Beautiful Bill. Make sure you understand how that impacts you. We're looking at that as well. So each time we get together, we look at our tax planning software and we can identify, here are the moving parts that might tie in for your personal situation, but going forward, we're also going to coordinate that with William and his team and look at these end of the year tax planning opportunities. As he mentioned, there's a couple months left to take advantage of some of these things in this tax year. And we also have our save the date. We have, I think, over 200 people registered for this now, but save the date and get yourself a spot for our pie giveaway on November 24th, 4 to 7 o'clock downstairs in our building here. And one less thing to bake here for the holiday season. You can capture that QR code or give us a call and we can get you registered for that. And as we wrap up, again, William, thank you so much for your time today and sharing your knowledge, your wisdom with the One Big Beautiful Bill and some tax planning strategies. And again, we are very excited about the relationship with you and glad that we've had that introduction through our mutual friends. And folks, thank you very much for, again, the opportunity to serve you in your retirement and also now with tax planning. Have a wonderful day. If you have any questions, give us a call. Thank you.
Thank you.
Yes, take care.